106.5 FM and 1050 AM, or on KCAAradio.com.
You're listening to an encore presentation of this program, KCAA, the Inland Talk Express.
Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's the telephone number. If you pick up the phone and give us a call, we can help you with your decisions. I know it's fall in 2018. There's a lot going on out there in the mortgage and the real estate business in the Inland Empire and all over California. I'm Jeff Barton, of course, your host. I really appreciate you listening to the show each and every week. KMET, KCAA, and of course K-Tahoe are the affiliates that carry the show, as well as YouTube. We're all over YouTube. If you go there and just type in my name, you're going to find the show. Jeff Barton is the name, and this show we record both for TV and for radio, so if you want to see me, that's terrific. If you don't want to see me, well, I totally understand that. I have a lot of people that don't want to see me each and every day. I want to get to many things on the show today. We had a little bit of a hiatus last week, and I think anybody out there who is in the mortgage business knows what that really means. What that really means is business is slow, so you might as well take some time off. Now, why is business slow? We seem to be improving in terms of the amount or the number of different loan options available for you if you're looking. For instance, the non-owner occupied loans are back. The stated loan, the dreaded stated loan, is back. The no income, no asset loan is back. Now, granted, these are not purchased by Fannie and Freddie or Ginnie. These are private label, private equity type loans. They're portfolio products, which basically means that the person who's giving you the loan is keeping and servicing the loan. But the options for people out there to get a loan are much greater than they were. There's actually an index out there, if I can look at it right now. Let me look through my notes here. The index indicates the risk that an investor takes on when they do certain types of loans. If the index is low, that means that the risk is low, obviously, right? If the index is higher, that means that there's more risk to the lender. Now, in good times, in times like we have now, where the economy is good, employment is good, we have a lot of people who are, I guess, in pretty good economic shape. Inflation is down, purchases are up in certainly a number of different areas. We find that that index rises, i.e., lenders are much more willing to take on risk in this type of environment than they are in, say, 2008, 2009, 2010, which we all knew were right after the recession, the very severe mortgage-related recession, which almost destroyed the world economy. So in those days, we would have an index around 1.2 to 1.4%, meaning that of all the loans done, the ones mostly at risk, or the ones that the industry was willing to take on as risk, were very low, 1.2%, 1.5%. That's incredibly low. Well, today, that index is actually 5.7%. Now, if you look in total to all the loans made, you will understand, yeah, that's still pretty low. But in comparison to what was happening right after the crash, right after the recession, you'll see that obviously we're almost 3 to 4 times the amount of risk that lenders are willing, or investors are willing, to take on today than they were at that time. Now, why is that? Well, we have a double-edged sword happening out there right now. We have a lack of real estate inventory, right? Which means that in most markets, prices are going to rise. So that limits the number of people out there who are willing to obviously take on an additional borrower, or willing to pay more money down, i.e. 20%, so they don't have mortgage insurance in any particular deal, so there's less borrowers. Also, the rising interest rates is also driving potential buyers out of the market because, hey, look, it's about the monthly payment, right? If you can't afford it, you're not buying a house. And again, the same relationship applies. If you need more income, you got to get more borrowers, and for many, that's just out of the question. You don't want Uncle George in there. What the heck? He's been a pain at Thanksgiving and Christmas for, 25 years. You want him on your mortgage too? No. So in all of these scenarios, if you look at the risk that lenders are now willing to take on based on those two factors, the 5.7 figure makes sense. Because if you're not able to take the loan you have as an investor and sell it to the government GSEs, i.e. Freddie Mac or Fannie Mae or Ginnie Mae, then what are you going to do with the loan? You got to keep it. So therefore, you have to improve, or you have to increase the margin of the amount of money you're going to make, i.e. the portfolio product costs more than necessarily a fixed 30-year loan that you're going to sell to Fannie Mae. It's just going to cost you more. One, because the risk is higher, obviously, based on this analogy I'm giving you, based on the numbers I'm giving you. And also, if you're going to take that kind of risk, you just got to make more money. It's like it is with anything else. That's why when people decry or get angry at those in an economy, which is a capitalist-based economy, because they're making too much money, and you hear this all the time, and by the way, they're in the election coming up. Anybody out there who doesn't vote, then you deserve the taxes that you're going to pay. In California, we are inundated with many different propositions on the ballot. Go through the propositions and look at it based on the Howard Jarvis Tax Association, that group, and also there's the California Taxpayers Association. There's a lot of groups out there who are going to try to sell you on a fee, a tax, and why it's good. Hey, I'm for helping the homeless. I'm for help feeding people. I don't want to see the dialysis patients not get treatment, but at the same time, the responsibility has to lie within the context of what we're already collecting. It can't be because we just don't have enough money. I don't know if anybody's looked at the California budget. It's in the trillions. This thing is unbelievable. This is the 5th largest economy in the world, and we're struggling to figure out ways to pay for things that either you believe, and many of my Republican friends do not believe, that government should be in the business of funding any of this stuff, let alone Social Security and food stamps and what used to be called welfare and all the rest of it. But if you are like myself, who's kind of middle of the road, who believes that, yeah, we should do something, but I don't know how much we should do, you really got to pay attention to those particular taxes in the upcoming election, in the propositions that are out there on the ballot. And I say this because all of these affect how much money you can borrow. Look, if you're going to pay an extra, let's say you have a $700,000 house you just bought. Well, $200,000 of that are going to be taxed without the mortgage-based reduction in taxes that we used to get. You used to be able to write off the interest on your mortgage regardless of the size of your loan, unless it was over $1 million. Well, now the threshold is $500,000. So if that difference of the $200,000, and again, in Orange County, average price down there, $1 million. I just heard on the radio the other day, again, on the radio, the median home price in Riverside County, this is Riverside County now, was $563,000. You think about that for a second. Do you live in a $563,000 house? Well, if you do, good for you. Obviously, things are going well, and you've done well in the last 10 years. But for a lot of people who don't, you can imagine the wealth that is surrounding you in a lot of the neighborhoods in San Bernardino and in Riverside, and certainly L.A. County. Orange County, I just said, was over $1 million. So Ventura County, Santa Barbara County, Inyo, a lot of these counties with good populations have a lot of money. So if you're reducing the amount of money based on that median of amount of money you can write off in your taxes, and you're thinking, well, you know, what's a couple $100 a month going to mean in borrowing power? Well, at 5%, it might mean another $100,000 that you can borrow, which may mean the difference between whether you can buy a house now or you're going to have to wait for the future when both the prices go up and the rate goes up, which is going to make it more expensive indeed. So what does all this mean? It means that we are in interesting times right now, And both here in the state of California and in the macro sense, housing is at a crossroads. And we'll get into that a little bit later. I'm Jeff Barton. I'm your host for this particular show, The Mortgage Voice. I appreciate you listening, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. 888-713-2929. That's our telephone number if you pick up the phone and you give us a call. You know what? Don't pick up the phone. Listen to the show. Write the phone number down, 888-713-2929. After the show, once you've formulated your opinions or your questions, give me a call. A lot of the people who listen to the show do exactly that. Mortgages are the type of thing whereby if you're listening and something pops in your head, it's better to write it down. Why? Because we might answer that question somewhere along the lines of the show, and your question may be so all-encompassing and, revert back to the who, what, when, where, and why of you as opposed to me answering a question, that it's better to get a little bit of a thought and then to give us a call. You can also email us, info@malibufunding.net. We do answer any and all emails, inquiries. Malibu Funding, who's the sponsor for the show, NMLS number 79620. Thank that company for sponsoring us. They have a website, and I work for them too. It's their website is www.malibufunding.net. And you can go there, you can look at all of the loan officers on that particular site. I think there's 45, maybe more, maybe less, something like that. I know Malibu Funding's in 10 different states, and for a list you can also go to that website. There are changes, as I was saying in an earlier segment, as to what's going on in the marketplace and some of the things that are relevant to you. If you're out there right now shopping for a mortgage, if you're looking for real estate, maybe you found something, but you're not really satisfied with what's going on with your particular broker or the bank or the lender that you're dealing with, you certainly need to get out there and shop. I would say do it prior to, but if you're in the middle of it and you're in that position, and you have a very short time to close, you really need to get to somebody quickly. You can certainly give us a call, email us. I'm Jeff Barton, as I said, and you can call or email me at any time for some information. Normally what happens is this: I'll get calls, emails, and I forward them on to one of the terrific loan officers that do work for us. I'm not an expert in every particular situation, nor do I have the absolute expertise when it comes to things like reverse mortgages. Nope. But we do have somebody who is certified, one of the few 150 certified people in the reverse mortgage sector, and she is terrific, Nina Penny. I think we've mentioned her on the show before, and she's been on the show as a guest. So for reverse mortgages, yeah, I'd go to her. FHA mortgages, I'd certainly use George or Connie or, Rick or any number of others. If you have a loan down in Florida, the Cristiano down there does a lot of loans for us, a lot of foreign loans, a lot of TIN number loans. We were talking earlier about the number of different products on the market because there is a great need right now for loans. And if you are reading the newspaper, let's say you go online and look at mortgage sites, you will not really read too much about the difficulties the industry is having. However, if you go to the business section of your paper or your website or wherever you look up this kind of information, you will see that mergers and acquisitions, i.e., two companies decide to get together and form another company, or one gets bought out from another company, or one actually goes out of business. This is because the number of loans that we're doing today is dwarfed by the number of loans we did 3 years ago. If we did $2 trillion of loans 3 years ago, we're going to do less than $1.5 trillion this year. Now, I say $1 trillion like that means something to anybody, but just imagine if you cut 25% of your particular income out today. Think about how much money you make. Let's say you make $100,000, and it's just getting you by with 2 kids and you got a house. Let's say $25,000 of that disappeared. Now you got to pay taxes and the same bills that you have today. What's going to happen? What's going to happen is pretty obvious, right? You're either going to have to sell your house and go and rent, or you're going to have to get a second job, or you're going to have not only both of you working, but maybe bring in a relative to live at home to help pay the bills. This is what's happening in the mortgage industry. Now, why does that affect you? People would say, what do I care? It's a mortgage company. I just go to a different bank or a lender. Competition is how you get a better deal. If there are 3 people on your block selling a particular thing, and next week there's one person on that block selling that same item, but you still need that item, that particular company or person supplying you that item can raise the price, and there's no downside. Why? Because there's no competition. Nobody's saying they can't do it. And in a free market economy, which is what we have, without competition, you have no chance to be able to negotiate with another lender. I know many friends who have got great credit scores, and if you're one of these people out there who has 750 and above, let's say it's 766, and you're about ready to go to a mortgage, you see the swaggered person on that commercial on TV that kind of struts around, I got this credit score, like, they're packing a big 6-gun, and they're just happy because they know that they can go into any situation that requires credit check and go, boom, I can get anything I want because I got a 767 credit score. Well, that is kind of the way it is if, in fact, you have competition. However, if you're that person and there's only one person in town offering you a mortgage, it doesn't matter what your credit score is. They're going to be able to dictate terms to you in a much different way. And I think for you out there who are looking for mortgages right now, competition is what to do, where to go, and to be in a market, or at least to be in an area, a place where you can shop a particular loan officer, a particular loan company. It's just standard economics. Let's talk about rates. Okay, in the news to use section, let's see, what do we got here for rates? I know I looked it up. Darrell, you know what the rates are?
I do not, but it probably starts with a 5.
It does start with a 5. Yes, it does. And one of the key components this week, let's see. Some September's weaknesses due to Hurricane Florence, continued sales fall 5%. No, that's not it. 5%, 5.1% is really where we are for 30-year fixed loans across the country on average. And what that means is that you might find somebody at 4.875, you may find somebody at 5.25%, but on average, if you're looking across the country, you're going to be seeing 5% interest rates, and that's not going to fall anytime soon. Now, why is that? A couple of reasons for that. The Fed has taken upon itself, due to inflationary concerns, obviously, is the main focus of the Fed, which, of course, everybody knows the Fed and the mortgage interest rate are not necessarily the same. However, when the Fed does scare the heck out of people by raising rates, and that's on short-term notes, on the discount window, on your car note, on short-term interest loans, on payday loans, things like that, right? Your credit card. This is what the Fed really affects when they raise short-term rates. What really happens is the banks have to raise their rates because obviously they borrow money directly from the Fed or the Treasury, and if they don't have a way by which they can pay those loans back, okay. So if you're in a position right now where you got a loan, or your loan officer says, okay, we're going to get a loan at 5%. and it's going to be a 30-year fixed loan, I would lock that loan today. Now, why do I say this? Because in short order, within the next 30 days, possibly within the next 45 days, we're going to see another rate hike. And when the Fed raises its rates, the banks are going to raise their mortgage rates. Now, my company lends money, right? The company I work for, Malibu Funding, they lend money. And where they get their money from, a number of different sources, and these sources are called warehouse lines. Now, all those warehouse lines get their money from who? The major banks. Bank of America, Chase, Wells Fargo, Flagstar is one of these accounts, and there are a number of individual small ones. But usually, most of these banks lend out, and that's why they got out of the wholesale business, really, which is really doing loans themselves through mortgage brokers. They got out of that business because it was easier just to buy loans in bulk from companies that became correspondent lenders. When correspondent lenders began to sell their loans directly to the banks, it's a much safer scenario, because if the loan went bad, you know, the guy who originated the loan and funded the loan is on the hook for it, not Bank of America. But because of these large-scale, banks lending out to correspondent lenders, anytime the Fed ticks up their particular rate, that means that the large banks are going to have to tick up their rate because their lending costs are higher now too. Anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks for tuning in. Thanks for being here each and every week, and we'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry, 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, you can reach us and we can talk about your mortgage, maybe have some concerns about the property you're about to get in. And by the way, if you're out there right now, I read an article that said that property inspections were back. What does that really mean? It means that it's becoming more of a buyer's market, and that's a good thing because negotiating price down is probably going to help you get the mortgage you need. Why? Because rates are rising, so maybe there's a bit of an offset. One of the things that I do on the show is to bring talented, experienced, knowledgeable professionals to tell you exactly what I don't know, which is most everything. Anyway, from Nations Direct, April Lopez joins us once again. April, how are you?
I'm doing great, Jeff. How are you today?
As I was saying, I think I'm a little stressed, I'm a little anxious, and I'm not really sure where the market's going. Give me some insight. What do you think?
Well, it's interesting. Statistically, since August 1st, what I've seen on the retail side is that the market's softening, meaning that we're seeing some price reduction.
Right.
We're seeing that more inventory is coming on the market, so the buyers are becoming a little bit more choosy, taking their time. So the interest rates are rising, and about the landscape from the lending perspective is changing to where about 50 to 60% of the future business is going to be non-QM.
Oh, that's interesting you say that. Non-QM. And, of course, this is private money, right? This is not government money. So is there that kind of influx of outside capital to fund this kind of stuff? I guess there must be.
Absolutely. What I heard today was Wall Street just really wants this business, and they have, you've got two big players, the big investors that is purchasing up this non-QM from lenders like us, and then lenders like us, Nations Direct, who have capital. We're doing due diligence on our non-QM, meaning that we're able to use our capital to hang on to the loan and sell it for a little bit more so that we can offer actually some better pricing to the consumer. So it's going to be a win-win. So I would say that attending a convention this weekend in Las Vegas, the AIM convention, that everyone's looking for non-QM. They're looking for we've got a lot of self-employed borrowers,
right,
that have bank statements, the non-traditional forms of income qualification, and the loan limits. In the metropolitan areas, the loan limits are exceeding the government-regulated standards, in which case...
Doesn't that come out this month? The new loan limits, isn't it? Thanksgiving that comes out, something like that, maybe right around now?
That's what I heard, but I haven't actually seen it. I haven't really read much about it yet, I'll be honest. But I don't think it's going to be anything exponential. I think that the government's saying, hey, we are losing some of this business now to non-QM. Let's see what we can do about it, right?
It's interesting. The competition, which hasn't really been around for about 10 years between the private sector and the government entities. Obviously with the Treasury sweeping profits from Fannie and Freddie every quarter, or maybe it's even every month, to the tune of, $3-4 billion every quarter or every month. That's a lot of money. And if you're not in competition, meaning that if you're the only game in town, it's no big deal. But if the private equity side gets involved and starts doing, she said 60% of loans, that's going to kill a lot of that government entity business, right?
Absolutely, because think about it, with the interest rates on the rise, and say some of the regular Fannie product going for 5 and a quarter, and all of a sudden you've got this non-QM product that's going to be like 6.5. How easy is it to sell that 6.5? And then for this private sector to be like, yeah, we want that business at 6.5. It's better than back in the day when the rates were 3.5, and then
of course,
sell the 4.5. Right?
I've always said this: we have to have mortgage rates at 6 to 7% to have the private industry want to get involved. There's just not enough margin in for it. Now, of course, the people who are anti-capitalists see this as a typical gouge of the consumer. But let's be realistic. If the government can't guarantee these loans because of the mortgage meltdown we had, i.e., everybody who is doing these loans is on the hook for them, and it's just freezing the market, you'd be willing to pay an extra point to be able to get a loan. If you were a borrower who is self-employed, I've even seen stated bank statement loans, all kinds of different products that didn't exist 3 or 4 years ago.
Absolutely. They came back with a stated 20% down now. One of
Right.
the largest competitors in the market is offering 20% down.
Right.
And actually, the rates are in the high fives, so the rates are even more competitive. So the buyer's like, of course. And you're seeing in this market
Right.
that more people are putting more down payment anyway. So it's
Yeah.
kind of gone back to the American dream where we used to say 20% down minimum, right?
Well, I like the 20% down because it makes me feel a little bit better. And also, I like the fact that the real estate market is cooling off. I mean, 6-7% every year is unsustainable. I'd like to see more like maybe 3 to 4% increase in value every year. To me, that's much more realistic and much less of a crash, I guess, risk. And I don't know how those things are. And how do you guys do it over at Nations Direct? How do you assess the real estate market and risk? What are you guys doing for that?
Well, I think that what we're doing is that we are just really trying to come up with some more product with the non-QM, right, and being able to get that business. I mean, from a risk perspective, I mean, we are just kind of taking it day by day. I think we haven't really, everything with the down payment, we're seeing more and more borrowers coming with bigger down payment. And with Fannie and Freddie, joining and also like doing appraisal waivers, we're finding that we find that it's very minimal risk. So we are just continuing on and just trying to be aggressive and being able to make, I know it's cheesy, but make it more affordable for buyers to get into this market.
Right. I agree with all of that. Long term, where do you see us in, like, let's say, first of the year, both rates and availability of programs?
Oh, my goodness. I would say that rate is going to be, maybe max, go up another quarter. And so I think the rates are going to sustain a little, and I think that the products is going to be, there's going to be so much more product. There's more lenders that are coming in the game. I'll have to tell you, Deep Haven just went wholesale.
Wow.
So that just killed all these lenders who are coring their non-QM business to Deep Haven, one of the largest that buys up this. They just went wholesale. Now, is that a benefit to them? I don't know for an investor to go wholesale, but I do know it's putting the pressure on. So I find that you're going to see more and more banks, bringing out more product. And when I say more, I just making it a little bit more flexible, maybe less reserve requirements.
Right.
Here in LA, just expanding a loan amount. So if they're max on a non-QM at $3 million, expanding those loan amounts where we can capture more of that larger jumbo product to $5 million, $7 million. That's what I'm seeing.
Yeah, I had a call from an account executive telling me about a income-based property, non-owner occupied, 20% down on just the amount of money that it made in rent, meaning that you didn't have to come up with any other documentation. As long as it cash flowed, you could get a loan on the property with 20% down.
How about we're doing that now at Nations? It's called our Investor Advantage Program.
There you go.
Much like the NINA program.
Right.
No income, no employment, no reserves.
Right.
20% down purchase, and they don't even have to debt service in our product.
And how do you qualify for the loan? Is it based on your credit score and the cash flow of the property?
No, it's just based on your credit score and your down payment. Because at that point, we want a 640 FICO, and you have 20%
low.
Down payment. Crazy, right?
Right, 640. I mean, I would bet over half the borrowers in the country have over that.
And it beats hard money. So think
Right.
about it. Hard money, outside of the credit requirement, you're not getting charged 3 or 4 points going hard money. You can get an actual good loan, whether you get a 5171 ARM with no prepayment penalty.
Wow, that's a very good product. State that again, will you? Because I think there's a lot of people in the audience who need to listen to this. What's the loan?
Absolutely.
Yeah.
So it's an Investor Advantage loan,
Right.
NINA product, which is no employment, no income, no reserves, 20% down on a single-family residence. It does have to be investment, and you do not have to debt service.
Now, this is a non-owner occupied. That's what you mean by investment, right?
Correct. Non-owner occupied only.
So this is like a commercial, right? It's like a commercial loan almost.
Not a commercial loan. It's just for those private investors, those buyers who just have and they can have 15, 16 properties. So it's like a true investor who buys properties.
And there are no reserves on that?
No reserves required.
Wow, that's awesome. Yeah, this other AE had reserves, and each property, in addition to the one that you had the loan on, you had to add another month's reserve. So let's say you had 10 properties. That means you had to come up with a year of reserves. Your product doesn't have that. Better product.
Yep, much better product, and I mean the rates are reasonable. I mean they're the mid to high sevens for an investment.
Yeah.
Think about a hard money at 9, 10, 12%.
Hey, listen, April, thank you very much. I appreciate that. I've gone over, of course. My engineer is looking at me like, what are you doing? Get off the air. Thanks very much for coming on the show once again. I really appreciate it.
My pleasure. Have a great day.
And you too. That's April Lopez from Nations Direct. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's our telephone number. If you pick up the phone and give us a call, we can help you with, all kinds of questions you're going to have. Changing market, rising interest rates, inventory maybe in flux right now. It looks like we're increasing inventory, longer time on the market for a lot of houses, which means that the balance between days on market or sold is increasing, which is a good thing for buyers. So if you're a buyer out there and you're still shopping, you might want to hold a little bit because you may have a better ability to negotiate both the price on the loan, and with rising interest rates, that's going to be good because it's going to mean that you can afford more house if you get a lower priced house, right? Because your mortgage is going to cost you more. We bring to the show everybody who we bring to the show on each and every show that we do is in the mortgage industry in one form or another. Michelle Weil has been on the show before from Orion Lending, and I really appreciate her doing so. She's, I believe, VP here in, are you on the West Coast or are you down in Arizona, Michelle?
I'm in Arizona, but I cover the whole country.
Oh, I see. Okay, very good. Well, anyway, welcome. Thanks for coming back on the show.
Well, thank you for having me, Jeff.
Okay, let's talk about what's happening at Orion. What's going on down there in terms of with rising interest rates? And the inventory is still pretty slim. What are you guys doing to increase the amount of programs that you're offering? I know we talked about it last time you were on the show, but maybe give me a quick refresher.
Well, what we're doing is we're expanding what they call non-QM loans and Alt-A loans. You have all your traditional loans that most people are used to getting, but there's a huge request for additional, more flexible underwriting guidelines and different items. For instance, self-employed borrowers who maybe would not qualify using their tax returns, but qualify using bank statements, whether it's their personal bank statements or their business bank statements, in order to qualify for a mortgage. And that is allowing a lot of people that maybe wouldn't be able to buy a home just a few years ago to be able to come in and either refinance the home they have now or buy a new home. And so that product is a very aggressive product. It does require a 10% down payment. Depending on your FICO score, the lower the FICO score, the more the down payment that is required. Right. But it is a very flexible product that allows people to qualify.
Well, I think 10% is actually kind of low. I mean, I've heard a lot of other account executives tell me 20% was kind of the minimum. Is that 10%? Yeah. That seems like a good deal.
It is a good deal, and we were at 15% just recently, and we just bumped it up to 10% down. And that, I mean, obviously, the less that they put down, the higher the interest rate. So if they have the ability to put more down, their interest rate's going to be more attractive.
What are the interest rates spread?
Are doing 5-1 ARMs on that. Okay. Just to get a little bit lower rate, and the potential that in the next 5 years they're going to actually have 2 years tax returns where they could go full doc.
Now, when you guys assess risk in terms of both the mortgages, obviously are based on the borrower and the ability to repay and all the standard guidelines that we do you look long-term as to what's happening in the economy, maybe what's going on in employment and inflation and all the other economic indicators, or are you just strictly focused on that particular loan in terms of assessing risk?
On an individual loan, we just focus on the individual loan. But when we do assess risk and look at the future and the market and all the other variable factors as we're writing our program guidelines and the different items that we look at in the guidelines in order to, find out if somebody is qualified for one of these types of loans.
Right.
Most people who are business owners are pretty responsible with their credit, but there are some flexibility in those guidelines right now. Now, a year from now, 2 years from now, we don't know where that's going to be, and that may adjust, and I anticipate that it probably will adjust, depending on what's going on in the market and what we, kind of foresee of what's going to happen.
Do you see more of a private investment coming back to the mortgage marketplace because the interest rates are rising, or do you not see that?
Absolutely,
right.
Absolutely. I mean, as you know, rates have been so low for so long, it wasn't very attractive for Wall Street to be involved in the mortgage industry because they weren't making much money.
Right.
But now that the rate environment is increasing, they can see a little bit more of a return on their investment, and they're definitely opening up to different ideas of things that they're willing to put money out on the table for lenders to offer to customers. We have another product that we just rolled out for people who are buying investment properties.
Right.
Where literally, there's no debt-to-income ratio done as long as the property itself that they're purchasing, the non-owner-occupied single-family or 1 to 4 unit property, if it debt services itself,
right.
There's no debt ratio done at all. It's just the property qualifies, you're good to go.
And who determines that calculation?
20 properties.
Oh, up to 20 properties. Well, that's interesting. I've heard 10, I've heard 15, 20 properties. That's a lot. The reserve requirements are 3 months?
The reserve requirements are, it's 2 months reserves up to 12 months for every non-owner-occupied property you own other than the subject property, and I believe it's 6 months for the subject property.
I see.
6 months for the subject property and 2 months for each additional property they own, up to 12. If they own more than 6 properties other than the property they're financing, it caps out at 12. So 12 months plus the 6 months on the subject property.
I see. Okay, so there are some restrictions in terms of what you need in reserves. What if you have a number of different properties already, in your portfolio, and you're looking to get another loan? Does that increase the amount of money you need in terms of your reserves?
In the reserves, so you would need 6 months for the property that you're buying.
Right.
And then if you had 10 other properties, 10 other finance properties, and they do distinguish between a finance property and a property that you own free and clear. So you only require reserves on properties that you have a mortgage on. And if you had 10 other finance properties, it would cap out at 12. So
I see. So a year is
primary,
right,
and then 12.
And these are all non-owner occupied? Investment?
Non-occupied, up to 20 properties people can pick up. Now, the down payments on those, it ranges depending on the credit score.
Of course.
But, it's a pretty aggressive product.
Hey, my credit score is
720 FICO,
right.
Up to $1 million property, you can put only 20% down on that product.
My credit score is 750. What?
I know, go buy 20%.
Well, Michelle is gone. I don't know what happened. We had her right there, and it was really kind of exciting being able to talk to her and keep her on the line, as we'll try to get her back on the line right now. What she's talking about in these non-owner-occupied loans is a lot of what April was talking about from Nations Direct. Whether that loan is better than the loan for Orion, I'm not quite sure, but I think really when you're looking at these types of loans, back on the line. Michelle, hi.
Yeah, sorry about that.
No problem at all. We just picked it up on the fly. It's live radio. What are you going to do? Happens all the time. By the way, are you a baseball fan?
I am, and I know your Dodgers are doing really well. Well, they're in the World Series.
It's really
better than my team.
Yeah, you know what? And I'm a Red Sox fan, just so we be clear on that.
Excited.
I know. I just had 90 people turn their radio off. It's just, if you're driving around out there, my second favorite team is the Dodgers. However, I grew up in the Boston area, and my allegiance is still there. So very happy that my team is doing so well. Regardless of that, Yeah, exactly.
Very exciting. It's very exciting, and it's better. Both of your teams are in the World Series, so it's a fantastic thing.
I know. I almost got a shirt made up where half was the Red Sox logo and the other half was the Dodgers logo, but I did a kind of a mock-up. It looked so ridiculous. I think people would have sent me away somewhere. So I didn't make it. I didn't do anything. When I was talking earlier about assessing risk, about looking long-term, both at the economy and how you handle loans, I always try to figure out, are you guys preparing for when the next recession is, or are you just hoping for the best?
You know what? We at Orion Lending, we are preparing. I mean, we don't. There's no definite time of when it may or may not happen. But I can tell you, there's a lot. Unfortunately, there's a lot of lenders in the mortgage industry that have been running at a loss all year long.
Yep, I know.
Because even though the economy is really strong for consumers, on the mortgage side, our margins are very thin right now.
Not only that, there are few loans.
The margins are thin, and we're looking into 2019 that rates will be sneaking up.
Yep.
And if somebody's going to buy and they're on the cusp of qualifying, I definitely recommend that they look at getting in. There are options, like non-owner occupied co-signers.
Yep.
To help you get qualified that are available on certain loans. To help that debt ratio get over the edge, but I definitely don't recommend people overextend themselves into a position where they end up in a foreclosure because they can't afford the payment.
Right.
That's something that obviously happened a lot before this last crash.
Michelle, thanks a lot. I got to go. Unfortunately, we're out of time, but I really appreciate you once again jumping in, helping us, try to explain and also telling about some great products that you have at Orion. Thank you very much.
Thank you, Jeff. I appreciate it.
Thank you very much. It's Michelle Wild from Orion Lending, and I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton. I'm your voice in the mortgage industry. 888-713-2929. That's a telephone number. If you pick up the phone, we can answer questions that you're going to have about your mortgage. There's a lot happening, a lot changing in the mortgage industry. One of the things that comes up every now and again is the flexibility of a broker, i.e. somebody who's in the wholesale business, not a direct lender and not a bank. But a lot of people here in Southern California use mortgage brokers, and there's a lot of us out there, and a lot of people who service their clients very well and who really try to take care the best they can. One of the things that has always hampered since 2010 the loan officer or the loan mortgage originator who works in wholesale as a mortgage broker has been the inability to be able to give up fees in order to make the deal work. I know if you're a real estate agent and somebody is, they're lamenting the fact that they have to pay a termite report because the lender's requiring it on an FHA home, then the seller doesn't want to do it, and the buyer has to come out of pocket. The real estate agent can therefore, okay, yeah, I'll help, and they'll contribute some of their commission towards this possible expense. Well, on the lender side, you can't do that. And you can't do that because of the LO Comp rule, which is the Loan Officer Compensation Rule. And it's very strict, and it was meant and has been meant to be able to not have the loan officer steer you towards a higher compensation. Well, that's all well and good, but some of the rules are beyond strict, and one of them, of course, is this inability to be able to say, hey, on that appraisal that's costing you $650, let me pay it out of my compensation. Well, you can't do that if you're a mortgage broker, and so it puts the borrower. And in Southern California, we probably have 30 to 40% of our borrowers using mortgage brokers. Why? Because banks got out of that into the business a long time ago. And correspondent lending has really only picked up in the last 3 or 4 years. So you've got a majority of your originations in Southern California, or a lot of them anyway, done by mortgage brokers. And without having the ability to be able to compete and the ability to be able to credit on certain circumstances and situations to the borrower, that's a bad thing. So the LO Comp rule, the Loan Officer Compensation Rule, is being looked at once again. Early on in the days of 2010, Dodd-Frank, the LO Comp rule was attacked by the National Association of Independent Housing Professionals, as well as the National Association of Mortgage Professionals, as being unfair and as being something that would lessen the competitive advantage it would be to go to a mortgage broker. Therefore, the only thing the mortgage broker could then compete on, because they can't give up some of their commission to help defray the cost of the loan, would be in service. And obviously that's where the market stands today. Obviously, service by mortgage professionals is a lot different and better than it is if you go to your local big box bank down at the corner. I mean, Chase Manhattan has many, many branches, but the loan officers themselves, and my own quick story with Chase, I tried to get a business loan with them. I wanted to take money out in order to expand my business. I never heard from them again. I went in, did the FICO score, did the credit score, did the income, did the asset, did the application. I never heard. I am still waiting 4 years later. Now, if you have this same experience with a mortgage broker, you're just going to walk next door to the next mortgage broker. So the competition in the mortgage broker world is strong. However, the advantage to you is just in service, should also be in cost, right? And that's what I'm trying to get to about this LO comp rule. Anyway, there are many, many different, thousands actually, it says in this article, of loan officers and executives in the business who have written a letter to CFPB Director Mulrooney to see if we can get the LO comp changed in order to loosen up some of the restrictions that brokers seem to be punished by as a result of what happened in 2007, 2008, 2009. And it has always been to the detriment of being a broker, because they've been easy, right? Because they were easy marks to be able to blame everything on in those days. And I don't know if you're seeing parallels. Daryl, do you see any parallels today to 2008 in terms of what's going on in the marketplace? I mean, you listen to the show, you're aware, astute guy. What do you think?
I think that, we're in a recovery mode right now. I mean, when we were double-digit inflation and we went down the path and we fell into the ditch, right? We're climbing out. And in order to have a healthy economy, we can't stay at 3 or 4 or 5% as far as the interest rates. Right. So I mean, we're climbing up. It's going to cost a little more, but to keep the economy alive and functioning well, everybody's got to make money, and the only way people can make money is when you're on the upside of this stuff. So
yeah, I think I agree with that. I think that there's a lot of call for continued strong regulation. Especially with what loan officers, everybody says that, right? I mean, whether you're a loan officer or a real estate agent or a car salesman, you're making too much money. Well, why is that?
I go back to Enron, right?
Right. I mean, well, that's right.
I was running a business, a fairly large-scale business at that time, and my consultant company was Arthur Andersen, right? Which was also the company that was consulting Enron at the time. And to watch that whole the fissures start and that whole company fall apart. Yeah. Under the mistakes that were made, and it was scary to watch.
There are still people that contend, and anybody who's listening, Enron is an energy broker. That's really what they did. They bought and sold energy from around the country and locked in long and short-term contracts. And what they did was they really leveraged themselves. Leverage is a big word. They borrowed a lot of money, is what they did, against future earnings in order to keep the ball rolling.
And a lot of people that are in the finance business saying leverage is a good thing, because, when you have debt in a business, when you owe money on debt, right, that debt is a write-off.
Right. Well, I guess from that particular tax standpoint, yes, it is a write-off. From a business standpoint, you got to make money, right? Correct. I need a new Tesla, don't you?
Yeah.
Exactly. So.
And one that hasn't been to space and back.
I know. I want that space one. By the way, Tesla's coming out with a new model car. I don't know if you saw it online.
I have not yet.
Oh, it's
Is
pretty
it like an SUV?
No,
an SUV
they just sort of
Jeep.
They showed the top of it. It was shimmering, right? It had this beautiful neon sort of stripe across it. It looked beautiful. And then, of course, they go to Elon Musk, and he looks like,
he probably hasn't slept a little bit.
It's quite a juxtaposition between one and the other.
You're over on the west side. Are you going to ride the sled?
You know what?
In
I'm
the
thinking
tunnel,
about it,
right?
aren't you?
I
want to go down and see what it's like.
It would be groovy to do 150 miles an hour.
This is the Hyperloop for anybody
Oh.
that doesn't know. What does it go downtown to the airport? Where does it go?
It goes from SpaceX headquarters for about 2 miles across the west side right now in Hawthorne.
I really want to see what it's like. Just because
150 miles an hour.
In Hawthorne, I think you want to go that fast. I'm sorry, Hawthorne, if you're listening. I love your city. Been there many times. I just figured that would be the best joke I could come up with in the moment. So anyway, back to what we're doing here with the LO comp plan and how we're trying to make the playing field a little bit more level. Mortgage interest rates this week, as I was saying earlier, 5%, 30-year fixed. FHA VA is 4.5 to 4.75%. It's still a pretty good deal, right? 15-year fixed, 4.5. 5-year ARMs, 4.25%. But how about April? Talking about that product,
that's amazing.
A stated product that you have 20% down. I don't care whether you earn a living, whether you don't earn a living. You just need to have a FICO score above 640, which, by the way, is just beyond dead, okay?
But see, what's going to happen is you're going to have a lot of people that can't afford their own home, but they've got investment properties.
Well, that's the point. How are you going to prove their investment properties?
You're going to be sitting on a park bench, and you're going to have income coming in from your investment property.
Now, we talk a lot about fraud. One of the things, and this is the last minute of this particular segment, one of the things that fraud is you know, if you go for a loan and you say, I am an owner-occupied loan, you get a lower rate, right?
Yeah.
Well, this is the reverse of that.
Yeah.
I don't live there, so you can just get into the property when, in fact, you're living there.
Into the window late at night. Yeah.
Exactly what you'd be doing, and I don't know if that's good. Anyway, thanks for jumping in, Darryl. I really appreciate it. Thank you for listening to the show. I really appreciate it. We will be on each and every week, and I'm Jeff Barton. I'm your voice for the mortgage industry, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.